This is lesson 5 video part 2. Starting with bonds, we're continuing to look at different investment opportunities. A bond is you certifying that you loaned money to a government or corporation and outlining the terms of repayment. Buyer may purchase bonds at a discount. When the time is up, the bond is said to have matured, which means it is at its highest worth or redeemable value. My parents purchased bonds to save for us to go to college. We don't see that as a means of saving as much at this time. Some types of bonds are corporate that are sold by private companies to raise money. If the company goes bankrupt, the bondholders have first claim to the assets before the stockholders, which is an advantage. Municipal bonds are issued by any non-federal government, usually meaning city. The interest paid comes from taxes or from revenues from special projects. We hear about school bonds all the time, and interest is exempt from federal income tax. That is how most schools are built, through these kinds of municipal bonds. The federal government bonds may be the safest investment you can make. My mother worked for the VA hospital as a nurse, and so she purchased bonds through the U.S. government. If the U.S. government goes bankrupt, it is obligated to repay those bonds. Mutual funds are professionally managed portfolios made up of stocks, bonds, and other investments. Individuals can buy the shares and use money to purchase stocks, bonds, and other investments. Profits are returned to the shareholders monthly, quarterly, or semi-annually in the form of dividends. Advantages are that it allows small investors to take advantage of professional account management. Normally, this is only available to larger investors, so that's a good advantage. Some types of mutual funds are balanced funds, which include a variety of stocks and bonds. The Global Bond Fund has corporate bonds of companies from around the world. The Global Stock Fund has stocks from companies in many parts of the world. The Growth Fund emphasizes companies that are expected to increase in value and also has a higher risk. The Income Fund features stocks and bonds with high dividends and interest. Industry Fund invests in stocks of companies in a single industry such as technology, healthcare, or banking. And the Municipal Bond Fund features debt instruments of state and local governments, and the Regional Stock Fund involves stocks of companies from one geographic region of the world, such as Asia or Latin America. Lots of different types of mutual funds that you can choose from. Stocks represent corporate ownership. Stockholders own shares of the company and are entitled by doing that to share the profit as well as to vote in the company and how it's run. The earnings are made of the company profits and divided among the shareholders in the form of dividends. These dividends are usually paid quarterly. Larger profits can be made through an increase in the value of the stock on the open market. Some advantages are the market value goes up and the gain can be considerable. Money is easily accessible. Some disadvantages: if market value goes down, the loss can be considerable. Selecting and managing stock often requires study and the help of a good brokerage firm. Another way to invest your money is through real estate. You can buy a house and live in it and sell it later at a profit in some cases. You can buy income property that you're going to rent, such as an apartment, house, or commercial building, or you can buy land and hold on to it until it rises in value. These were good ways to invest. In some areas, they still are, but you have to be very careful when you're investing in real estate. Some advantages are that there is usually excellent protection against inflation, but not always the case in recent history. Some disadvantages can be that they are difficult to convert into cash quickly. If you need cash and a specialized type of investment required, study and knowledge of business, so you need to know a little bit about real estate before you try to do this. Capital gains or profits from the sale of capital assets such as stocks, bonds, and real estate, these profits are tax deferred. You do not have to pay the tax on these profits until you sell the asset. Long-term capital gains occur on investments held more than 12 months. Short-term capital gains occur with investments held less than 12 months. Retirement IRAs are another way to invest your money. They help individuals set aside money each month for retirement, even though you may be paying into a retirement plan. It's not always enough, and so it's a good idea in order to keep up with inflation and to have a good retirement to add to that each month. Federal income tax is not immediately due on this money that you've taken out of your check each month to add to your retirement. Income tax is paid when money is withdrawn. Penalty charges apply if the money is withdrawn before retirement age, usually, in most cases, before the age of 59. The retirement income is lower, so your tax rate is lower when you get ready to withdraw the IRAs. They allow a person to contribute up to $3,000 of pre-tax earnings per year. Contributions can be made in installments or in a lump sum. The Roth IRA, also sometimes called the IRA Plus, is a $3,000 annual contribution, but it's not tax deductible. The funds from the Roth IRA may be withdrawn after age of 59 if the account owner's disabled, or for educational expenses, or for the purchase of a first home. They are not a tax deductible item, as I said. The 401k allows a person to contribute to a savings plan from his or her pre-tax earnings, reducing the amount of tax that has to be paid. Employer-matched contributions up to a certain level in a 401k and KEO plan allows a self-employed person to set aside up to 15% of their income, but not more than $35,000 per year, which is another type of retirement plan. If you made a $2,000 contribution for 9 years for a total investment of $18,000 at an interest rate of 9%, by the time you were 65, you would have $570,947 in the bank, which is more than $500,000. If you waited to contribute from the ages of 31 to 65 for 35 years, a $2,000 contribution each year would give a total investment of $70,000 at an interest rate of 9%. Then by age 65, you would only have $470,249. The younger you contribute, the better off you are. Avoid investment fraud. Each year, billions of dollars are lost to fraud investment. Some of the most common include illegal pyramids, insider trading, and unlicensed investment brokers, high-risk penny stocks, and fraudulent securities, fraudulent franchise and business opportunities, internet services, 900 numbers, and the list goes on. You want to be sure that you are investing in a legitimate investment. To protect yourself from becoming a victim of investment fraud, you want to become informed about investments in industries before you invest. If you're aware that there is some fraud, it is very helpful to know that. Talk with others who have made similar investments. Obtain information from state and federal regulatory agencies. Never invest over the phone. Avoid investment opportunities promising large returns in a short amount of time. And again, that too good to be true, because they probably are. You can get more information from fraud.org or ftc.gov about avoiding investment fraud. So be sure you are investing your money in a legitimate place by doing your research. End of video.